All right. Welcome, ladies and gentlemen. Welcome to the midweek technical and fundamental analysis. Before I jump into the analysis, let me give a quick disclaimer as always. This is not financial advice. Anything that we share during these analyses is for educational purposes only. I repeat, this is not financial advice. Anything that we share during these analyses is for educational purposes only. Cool beans? Cool beans. So, the midweek technicals will be brief. We're still on the same side of the pre-week analysis and beginning of the week analysis, right? Told you guys that I was bearish in the pre-week analysis for the dollar index this week. I wanted to see us target weekly and daily uh sell side liquidity, right? Where I have the arrows drawn down to, right? And I told y'all that this weekly fair value gap is my area of interest. My point of interest is where I see price coming down to before either retracing up into this imbalance and running this buy side liquidity. Um, Sorry about that. Yeah, running this buy side liquidity, right? And so um we got the sale off of the weekly, I'm sorry, off of the daily PD arrays that I wanted to see Monday, right? So down Monday and Tuesday, right? We had a pullback today back up into the daily PD array levels, right? Did not break and close above either of those levels. So I expect Thursday and Friday to be a continuation of Monday and Tuesday's bearish move. Cool beans, cool beans, easy peasy. On the flip side, if we do break above those daily PD array levels and we close above them, right, then of course we would target this daily volume imbalance, right, and next this inverse daily fair value gap that we see here, right? And if we break above that aggressively and close above it, then we will start to target the daily PD array levels that we see here to the upside, but the bias is still on side and in line with the pre-week and beginning of the week analysis. Cool beans, cool beans. So let's look at currencies. I told you guys, of course, I was bearish the dollar, and we know that currencies are inversely correlated with the dollar, meaning they move in the opposite direction. So, being that I was bearish the dollar this week, you know that I was bullish currencies this week, right? And exactly how I have it drawn out, had it drawn out for you guys in the pre-week analysis in the beginning of the week analysis is how we've pretty much seen price play out um for the first half of the trading week. I told you guys that I expected us to buy off of the weekly, I'm sorry, off of the daily PD array levels, right? And Monday night in the beginning of the week analysis, we was right here during the class. And I told you guys that I wanted to see us push up off of that level. That's why I had the arrow drawn up off of that 62% level. I wanted to see us come up into this fair value gap, aka SIBI, sell side imbalance, buy side inefficiency as coined by Michael Huddleston. I would have loved to see us um, run these highs, but it's cool. We ran up into the fair value gap and we pulled back down as I had it drawn out into those same PD array levels that we broke up, um, broke above, right? And we come back down, but we came lower, right, into this imbalance, right? Rent this sell side liquidity here. So I'm expecting euro to keep higher, to keep pushing higher to close the week. If we go back to the daily, we see that we got our two bullish days, Monday and Tuesday, up off of those daily PD array levels, right? We pull back down into pull back down into the PD array levels that we broke above Tuesday, right? From Friday's bearish price range, right? And today we pulled down into yesterday's PD array levels, right? So if you didn't throw your levels on there, you should have had your daily levels on there. You should be placing those levels on there every day, right? And you can go from wick to wick or body to body, pretty much. Levels is gonna be in the same place, pretty much. See, body, body, take it back, wick to wick, pretty much same thing. Either way, price came back down into the daily discount array of yesterday's price action, right? Yesterday, price action right here, right? Price came back down into the 62.79% of yesterday's price action, which is your discount PD array level, right? Um, if I throw that field back on there, you see that, right? Price closed above that 62% PD array level. I expect I expect Euro USD to continue higher to close the trading week. Cool beans? Cool beans. Same thing with pound. Same thing with pound. Told you guys Monday that I wanted to see us buy off of the daily discount arrays, 79, 69, 62% levels right here. Um, at the time of the call Monday night, price was right here. And as you can see, price gave us a good push up for well over 80 pips. If you took your buy off of that upper discount array level, it did not pull back to the 79 at the time of the call or after the time of the call. This is 8 o'clock Monday night, right where my crosshairs at. Price did not pull back down to the 79, but you did definitely have the opportunity to buy off of the 62 up into this fair value gap, right? And you see price came up into that fair value gap and sold off back down to the daily PD array levels, right? Um, for the pound, we could see the pound make one more um reach down to run that sell side liquidity, daily sell side liquidity, and continue higher. But I would like to see the pound as well as the euro continue higher to close the week. Cool beans, cool beans. Um, looking at NZD USD, same thing. Um, told you guys exactly how I had it drawn out Monday night. Monday night, we was right here. Told you guys that I wanted to see price run that weekly buy side liquidity, come back down and retest it. You see, we ran it. Price came back down and retested. And now I expect price to continue higher for NZD USD to close the week. Y'all know that this is my point of interest, these fairly equal highs that we see right here inside of this daily fair value gap. Cool beans, cool beans. Looking at futures, E-mini S&P 500 futures. I told you guys that I was bullish this week for futures, and you can see from Monday to yesterday we were bullish, right? And today was definitely a bearish day. We came back down to run yesterday's liquidity PD array, discount PD arrays, Mondays, discount PD arrays and sell side liquidity. We came all the way back down to run last Thursday's sell side liquidity, right? And we came inside of that daily fair value gap, right? Right here, you see that fair value gap? Price came down in there slightly, and then we closed above that sell side liquidity. So moving forward for the rest of this week, for Thursday and Friday, I expect us to be bullish to close the week. I want to see price at least pull back up into the premium array levels of today's price, right? So these levels here, the 62 and 79 daily PD array levels, I want to see us at least pull back up into there, right? Now if we get there and we blow through those PD array levels, then I expect ES to continue higher, right? But if we start to show resistance at these levels, right, I would start looking for smart money reversals, to come back down into this imbalance right here, right? So that's what I'm expecting out of ES. Same thing out of NQ. Exact same thing out of NQ. I expect us to pull back up into the premium array levels from today's price range, right? And we will see what price does when it gets there. If we blow through it, then I expect NQ to continue higher. If we start showing resistance there, I start looking for smart money reversals back down into this imbalance here, this fair value gap, right, between this candle's high and this candle's low, right? So that's what I'm expecting out of futures. That's what I'm expecting out of technicals for the remainder of the week. That will conclude the midweek technical analysis. At this time, I will pass it over to Carmen so she can give us the saucy fundamentals for the midweek fundamental analysis. It's all yours, Carmen.
All right. Hi, everybody. I'm currently over caffeinated. I just wanted to start out by saying that. Um, anyway, so that is actually a good thing. Um, I guess for me, maybe. I'm very focused when I have a lot of caffeine. So what I've been doing since I got home is going back through the Dow chart since slightly before the Great Depression. And I'm just going to show you. I think it's kind of cool. Um, so let's see, I have gone through this chart and I've marked up every low to high. So I started marking the beginning of years, um, because I was reading an article today and it made me realize like how repetitive the market is, and how when you really study markets, you can find the patterns in the market. So currently we're at a pivotal point, if you want to say that, for the markets, because we're at a point where the markets are hitting all-time highs. And it's funny because everyone's panicking going into 2024 over rates. Is the market going up? Is the market going down? Bulls, bears, who's going to win? Who's going to lose? 401ks, like just a whole lot of stuff. But no one's talking about how the market actually performs when it hits an all-time high. What does the market do? How long does it stay at an all-time high? And then how long does it take before it actually gets back to the all-time high? How long does it dance around it? So this is a long time ago. This is wait, hold on, switch this. Okay, there we go. Um, so this is like back in the mid 80s. So um the market used to be very repetitive. So if you look, when the market would go up and hit an all-time high, it would stay at that area and kind of dance around it for 3 months before dropping off And then it would take some time before you actually got back to that all-time high. How long? I don't know because I haven't actually counted the months yet, but as you can see, it's relatively close to, I don't know, 9, 6 months. Sometimes it took a little bit longer, 18 months or so. But the pivotal point you can see is when we hit like the 2000s. So dot-com bubble, tech enters the space. There's like a changing of the guard and how the markets performed. The new revolutionary things started coming out. So um you started having all of this explosive market movement. And it pretty much does somewhat of the same thing that it used to do. Um, so all-time highs, you'll have the market stay there for about a month or two, maybe 3, but then you do end up getting a pullback. I'll measure those. I want to average to actually see like how long on average, or sorry, how far on average the drop is after a new all-time high. So we do have a couple of situations where um it was an anomaly. So you had an all-time hit, but this was like literally right before the housing crisis. So had we not had the housing crisis, we were on pace to hit an all-time high and like continue, I should say, a run of an all-time high. But this bottom purple line is a previous all-time high, and I just think it's funny how you had this all-time high hit and it came down and hit the previous all-time high, which we kind of know, if you want to use previously learned terminology, support and resistance, breaking those and come back and retesting those levels. But 17 months from the top all the way to the bottom, and then I haven't measured it to the technical like new all-time high after the '08 crisis. But it's kind of nice to look at these intermediate highs that were made in between. And then I measured what happened during COVID. So compared to '08 was like a mid 50s% drop from the high to the low. COVID was like 37%. Um, and so from that low to the high that we're now retesting um was, it's a little messy. I think that's about 28 or so. So about 2 years um to hit a new high. So um now we're currently retesting. So if you think about where the markets were at that point in time, this is how I kind of frame my thought process with this news that we have coming out and then also going into the next year. So what were the things that were going on during COVID, before, during, and after, that would now have the market looking differently at that same news? Or comparatively speaking, how are things now compared to then? From an economic standpoint, not from a socio economic standpoint or a sociological standpoint, like with how people deal with things, how people are interacting, because people are fickle. I don't care about that because that's more of an emotional part of the market. From a fundamental standpoint, actually looking at what were jobs like, um, what were jobs like, what were things like in the marketplace then compared to now. Zoom, I don't know what it is with technology today, yesterday, like Anyway, all right, let me find my chart. Oh wait, hold on. Hold on. I gotta actually like go back in and like pull everything back up really quick. It's not gonna take long. Um chart. But all right, so as far as this chart is concerned, that I had pulled up, it is definitely one of those charts that I feel like is going to be very pivotal for us to just be able to look at and study going forward, because as we hit these areas where we have all-time highs, um we have to know how the market's going to react, and we also have to know how to best move on the information that's coming out of the news cycle. And I don't think that anybody should panic or anything going into a new year, just because of the fact that um we're at the top of a market cycle. The really cool thing about where we are is that if history repeats itself, um, we'll continue to remain at levels very similar to this, at least going into the um, first quarter of next year. So, um, what I'm looking to do and what I'm looking to see out of this data that I'm collecting is, whenever I'm looking at these highs, I want to know, first of all, kind of like my Bitcoin chart, how long does it take to get to this next high? But then I also want to know, like, what percent difference is it? Again, when you have explosive growth out of the markets, um, the biggest thing is looking at what's actually going on. Like, what did the Fed do during COVID that is still going to impact us today? And you can actually go back to and look at, we can look at it now, like even back here in '08, um, you know, interest rates dropped a lot. And then we had this huge explosive movement in the marketplace. We had a slight downturn here, pull back in the market, some market reprieve, if you want to call it that. But then we pretty much had another, what they would call, bull run going into COVID. However, also understanding market cycles, knowing that, hey, we were kind of at the point where we were supposed to have something happen. That something just happened to be COVID. Now we're at that same point in time. So what I really would like people to understand is, like, um within reason, you can say that there are certain things that are supposed to happen in the market. Having an occasional 5 to 10% decline in the marketplace is not uncommon. You see it, but it's one of those things where you see it and then you recover from it. Having an event like COVID is what they call like a Six Sigma event, a black swan event, whichever one you want to call it. But if you think about a bell curve, um, if you think about a bell curve, this is your average, roughly. Six Sigma events are like way out here. Like all of this over on the sides, that's technically like your Six Sigma. It's like way out on the outskirts, meaning they're so unlikely to happen, people don't even think about it. Like war, war is closer to the middle than something like COVID. Um, Having a recession is closer to the middle than COVID. It's not every day that you just have a pandemic that's going to shut down the world, have, you know, countries coming together saying this is what we're going to do and pretty much making people follow a particular set of rules. So that's why they're called like Six Sigmas. It's six standard deviations away from what's normal, which means it's like no one's thinking about it. Um, it's so rare in my eyes in common time because it's not something that has happened on a global scale like that since the Spanish flu. That I don't want to pay attention to it for part of my analysis, because when I think about what was going on right before COVID, the Fed is literally right now um, doing what they were getting ready to do at that point in time. Saying it like that scares some people because they're like, oh, wait, are we getting ready to go back into something crazy? Well, I mean, it is an even year. However, it's a presidential election year. So you can expect that the current administration, as well as the Fed, even though they say they are independent, they do have some bias towards trying to keep things um good on the up and up. Um, Not necessarily for the current administration. It just happens to work out that way. And some people will say, well, this is their job. Yeah, it is, but they try to do their job extra well on a presidential election year or in a presidential election year, because when they do those things well, then it helps to look favorably upon them so then they can keep their job. Because some of the seats that happen on these independent boards and stuff are more you're nominated, and then um, policy is easier for you if you do things that help to make the current administration look good. So um, hopefully working on this chart will help us to kind of gauge how long we're going to stay at levels that are relatively like this. And it's not going to be perfect. Obviously, it's not going to be one of those things where you're just like, oh yeah, like got it. Bitcoin, however, is relatively it's repetitive. It's actually more repetitive than these markets. But I think that it will be cool because, you know, we are sitting at those levels right now, break through those levels going into the new year, and then see how much we're potentially expecting the markets to push above the previous high, um, before we get a market that just decides to take a breather. Um, So that's what I'm looking at as far as this chart is concerned. We did have some news that came out that would help to shape our fundamental view of um, these news items going into the new year. So let me see. I'm just going to stop sharing this screen really quick and share um, Forex Factory calendar just so that we can talk about it. Um, all right, so we did have some news that came out today that's actually pretty decent on the consumer front. So existing home sales were above forecast, and then we also had consumer confidence news that was above forecast as well. We have had lots of news items come out that would actually help to shape the mind of the consumer so that consumers are feeling a little bit better about what's going on. Remember, last class we talked about how hearing the Fed say that they're probably not going to raise rates anymore and could possibly drop rates, hearing that before the meeting, kind of helped to set a mindset and a thought process for how the consumer and also businesses are seeing things. So now we'll be looking towards news for tomorrow and Friday. So final GDP numbers, unemployment claims, and then really the big news item is going to be this core PCE number for the US because again, that's one of the metrics, one of the measures, one of the numbers, one of the news items the Fed uses to look at how the economy is looking. It's like one of their measures of inflation because you are looking at price. You're comparing prices of items in their respective groups, and you're also comparing those items to themselves, but from the previous month's data that came out. So as we look at that data, what I expect to see is that inflation is not going to have gone up from the pricing perspective, meaning when you start to look at items that you buy in the store every day, paper products, meats, eggs, milk, those sorts of things, the price for those items should not have gone up. And some people will say, well, what about different parts of the United States? It's an average. You're kind of taking all the information and you're averaging it all together. So for the majority of the United States, you don't want to have seen any of those prices go up. If anything, you want to see those prices start to come down, and or if they do go up, you don't want them going up by a lot. Meaning if the month before you had prices going up by 0.5%, you don't want prices going up by 0.5% anymore. It should be under 0.5% for any growth or any increase in price, or a straight up like decrease in the percentage of price increase. So none of those prices should have changed. Yes, we're in the midst of holiday season, so I don't expect that gas prices will change a whole lot. However, as soon as January 1 rolls around and we start going into this lull where there really isn't a holiday, people aren't going to be traveling quite as much, that you do see a decrease in gas prices. I do expect, though, that if you're talking about energy and oil, we will start to see a slight, not a lot, but a slight increase in natural gas. And the only reason why I frame it that way is because if you look at weather patterns right now, Canada for this current week and the week going, sorry, so for this week, but then also for about half of next week, the week of Christmas, they have temperatures predicted to be anywhere from 20 to 40 degrees above average. So if you look at a weather map and you do like a 10-day forecast out, like Canada, and you just do it based on temperature change alone, don't actually look at the true temperature, but temperature change above, at, or below average, they're going to be above average. So that means that they're not going to be using the energy products that they have been using before. Same thing for the Northeast. Currently, the Northeast has been getting hit with ice storms and blizzards and stuff. But as that system moves south and east, I expect that we're not going to have the energy use that we've had before. You have parts of the United States who, during this time of the year, they would have already had their first snow. They would have already had freezing temperatures, that sort of thing. No, they're getting thunderstorms, tornado warnings. Like, who would have thought you'd be talking about tornado warnings for Chicago and parts of Pennsylvania in December? Um, so to know that that far north, we're talking about thunderstorms and not snow, has me thinking that we're not going to have that natural gas energy usage that we had before. So my focus on the oil and energy sector is going to be strictly on gasoline. There are some reasons for that too, not only because we'll have a shift out of gasoline, because of the holiday season. But if you look at some of the news coming out of, I guess you could call it the Middle East, but it's like Eastern Africa, the Suez Canal, that area, they've been targeting ships coming through that area. So resources are going to have to be rediverted, more energy usage, more so fuel usage, because if you have to go all the way around Africa instead of using the canal, that's almost an extra, depending on where you're going and how tight you hug the coast, an extra about 6,000 nautical miles. That's a lot of fuel. So my thought process is that hopefully it will kind of balance itself out, because whatever overage we have will go towards helping an ally. Um, Russia, Ukraine isn't really that big of a deal anymore when it comes to energy usage, because things balance themselves out. Um, so that's my thought process for thinking about the markets, thinking about what areas of the market to look at, focus my attention on, or focus my attention away from. And then Friday, also durable good orders are coming out. So orders for products that last anywhere from 7 to 10 years is a durable good. These are furniture items. Technically, TVs are supposed to fit, but with technology, that doesn't, they don't really consider those to be TVs, computers, phones aren't technically durable good items. They could be. Appliances. Think about anything you get a warranty for and they give you like a 10-year, 5 to 10 year warranty, that's a durable good. The transport of those should get cheaper after the holiday as well. So I expect that people who still have money, because there's a lot of money still floating in the system that the Fed wants to dry up, which is part of the reason why I don't think they're initially going to drop rates as many times as a lot of people say. Some people are saying 6 times. I think maybe 3, because when you look at the money that they gave for COVID, going back to the chart, and just thinking about how the market moved, the Fed put a lot of money out there in the form of quantitative easing. They, gave out their form of stimulus to banks. But then the federal government turned around and gave out checks to people. So you had not only your federal government, but you had the Federal Reserve giving out money. So it was coming from both sides. Now that money has to be dried up. There's too much of it out there still, even though you have people who are lobbying and saying, well, the Fed wants us to lose our jobs, and why is it the Fed wants people out of work? That is the way. If you look at how the Fed can mandate things, the federal government always is going to say, we want people to have jobs and to work. But when your economy is not functioning the way that it's supposed to, no one who's in office, no president, you're not going to hear a president say, we want people out of jobs. That looks really bad. So the Fed has to be the bad guy. And the Fed has to say it in a way that doesn't make them look bad, because people are going to say, do away with the Fed, which they could possibly do in the next couple of years. Congress could just take it over because of their own debt. But anyway, um, the Fed has to do it, and the Fed has to make things so expensive that companies say, look, we can't afford to have people because people are too expensive. We still have to get a product out. We will make do with a skin and bones, a bare bones company structure until the economy turns around. So when you start to look at companies like Meta, Amazon, you have a lot of companies out there that are currently laying off people, cutting their workforce. You have companies that are merging together so that they can share, in a way, staff, or they can merge departments and then cut the fat. It's like, look, you have 10 people in the IT department. We have 10 people in the IT department. Let's bring them together. And we really only need like 15. So 5 people are going to get cut. You have companies that are separating because parts of companies really only require research and development right now. They don't require a lot of manufacturing, or they found a way to make the manufacturing aspects of their job with AI and robotics dependent. So anyway, next year is going to be that year where you hear, it's not going to be implemented, but where you hear a lot of corporations talk about the use of AI in their business model, starting with Apple and all your Q1 earnings people, especially January, February. Um, those are tech heavy earnings months, January and February. So if you own NASDAQ, or if you're, sorry, not own it, but if you're trading NASDAQ futures, that one's the big one. I would pay attention to the S&P if you're trading futures around but be careful, especially when Apple's earnings come out because of the news they had with their watch. So if you're trading futures, just mark that date on your calendar. Not saying don't trade, I'm just saying be aware of when it's happening. So if the market does do something funny, you're aware of what's going on that week, because it's literally a series of tech companies that all have their earnings coming out in the same week. But when you have those companies report their earnings, it's going to say a lot about the business climate and how things are going to go for 2024. Expect they are going to talk about AI, but they're not going to implement anything right now. Companies, governments do a lot of talking in an election year. You don't have the implementation of anything really until the year after. Everybody wants to see who's going to be president for this next term. No one wants to implement a huge 10-year plan, or not 10, let's say a 3-year plan, and then you have a president who's not going to support it, because you're just going to be fighting an uphill battle the whole time, sitting in front of Congress every other day. So they'll talk about it. They'll see where the consumer thought process is about it, see if they get any backlash. They'll backtrack if they get the backlash. Oh, we were just saying, we were just thinking, blah, blah, blah. And then they'll just actually do it later. It's kind of like with COVID. You test to see how people are going to feel about being restricted. You throw out hints of martial law when something very small happens. People are like, oh, you can't hold me at home. I'm not going to stay at home, blah, blah, blah. COVID happens, and then what do? You lock them in the house, tell them they can't come out, and they're on curfew. People do it. It's like people say a lot up front, but are they really going to be that rah-rah when you actually do it? And again, like I said at the beginning, people are emotional. So can't really depend on people. Got to look at the numbers and what people actually do as a result of your actions. So AI, robotics, cybersecurity, and data centers are really going to be like the hot button topics for next year. I expect that a lot of the market movement we get from next year is going to be based off of those things. Um, let's see. And that's really it. Um, those are just things I'm thinking about, things I'm looking at, because eventually we are going to get to the point where companies are going to start cutting their workforces. Not a lot, but it's going to be a very, very small trickle down effect. You have Walmart, for instance, right now. I'm gonna say this and I'll be done. Or maybe two more things after that, and then I'll be done. Uh First, you got Walmart saying that they're going to bring back cashiers potentially because of theft. It sounds really, really good until you start looking at what Walmart is doing in the background. Those metal detector things that you walk in between to go in and out of a store, the company that makes those has developed an AI, or they're developing, I should say, an AI model that connects in with security systems and scanning systems. So now, okay, cool. You're shopping in the store, you have your stuff. Like, what aisles was this person on? The same way in China that you can track a person from the time they left their house to the time they get to work, and you can see how many times they jaywalk. By the time they get to work, it's already calculated, and their social credit score is already dropped or has been docked 2 points. Yeah, same thing when you like shop in the store. It's going to be the exact same thing. You walk in, and everywhere you go, whatever you pick up, whatever you touch, that you put it back. And it's going to follow the same model as like the Amazon Fresh, the Amazon standalone stores, where you just walk in, grab a basket, put stuff in a basket, and you just walk out. Same thing. Because if you don't pay for something, you are going to end up paying for it. You might not show up on your receipt, but it'll come out of your account. Because it's tracking you. And if you walk out and it notices there are 18 barcodes in this bag, but when you were in line 7, it only captured 15. Oh, guess what? Yeah, you're gonna have to pay. And it's gonna know which barcodes weren't paid for. You get charged for them. How? That same method of payment. And if it was cash, I'm pretty sure that they're developing a method for that one too. No cash. So anyway, I'm done. Hopefully we'll get a chance to look at this Dow chart together and kind of find some patterns. If you want to pull up the chart too, I just started working on it. So if you want to pull up the chart, start just going through it, see if you can find some patterns, because I think this is going to be our thing for next year, is like going where other teams don't go and doing what other teams don't do, because um we can't, we're at a point in time in the market where you can't repeat old cycles. We're going into a brand new cycle. We're at all-time highs. We're at a pivotal point with an election year coming, or with an election coming. We're at a pivotal point, and this is the biggest part, um, where companies are having to change. So for anybody on here, um, who is looking at companies to put into a stock portfolio, here's the thing I want you to look at. Put a company that you're thinking about next to its peers. What is that company's plan for change? Because some companies can't pivot. A really good example of this would be BlackBerry. BlackBerry used to be the premier cell phone company for business and corporate use, And then it became more of a everyday, everybody's using this phone, but they were known for their security. Like BlackBerries had like the best cell security, well, phone security. That's why corporations love the phone. But when you think about BlackBerry today, BlackBerry is just a cyber security. Um, they just do security. They just do setting up really nice barriers of security for devices. That's all they do. They don't make devices like they used to. They're not the premier player in the market. Garmin, on the other hand, if you think about them, Garmin was that company where they only catered to pilots, they only catered to boat captains. They had a contract with the government for a while. Enthusiasts and those who participated in outside sports loved Garmin for recreational use, although it was at a high price point. Now, Garmin, I had the chart pulled up earlier today. It's like 1,200% higher than what it was like at its lows, like way back in, I said way back, gosh, but like back in 2007. But when you look at it compared to its peers, they're out, they were able to pivot. They were able to do something that their peers couldn't do, and they were able to shift into markets that their peers couldn't shift into. So this is going to be that time now where Apple, even though, yeah, they're premier cell phone company, everybody's using an iPhone, that sort of thing. You have Google that has phones. You still have Motorola out on the marketplace. Nokia here and there. But they're in a saturated market. Whoever is going to be the first cell phone company to pivot into something new, phone technically is obsolete. Like, even though everyone carries one, cell phones, as far as technology is concerned, is old. We've had cell phones around for a long time. They've changed in the functionality, but what is going to be the next thing? How are they going to pivot? When you look at computers, computers are getting thinner, screens are getting smaller, but how are you going to pivot? Like, is it going to be a projection type thing? Is it going to be something where you wear something similar to a watch and then it projects onto your hand and that becomes your screen? Like, what is it? So when companies are out here talking about change, if you look at their financials, if you are that kind of person that wants to go look at a 10K, 10Q, look at their quarterly or annual numbers, I want to see money being poured into research and development, because that lets me know that you're out here trying to do something new. And it can be as what some might say is silly, but as silly as Elon Musk talking about Neuralink having a chip in somebody's brain that can think a text message and it sends it, or thinking that you need to do something and that thing happens. Um, so like, it might not necessarily be an immediate thing, but for sure, I want to see companies next year, especially when rates start to fall. And if they don't fall next year, when rates fall, I want to see companies pouring money into research and development, trying to become that new thing. Whether it's sensors, some type of new phone, some new innovative way to do something that is going to be beneficial, that solves a problem. If a company is solving a problem and pouring money into research and development, I want to know. Like, just me. Like, I want to know what it is they're thinking about. I want to know how, like, they plan to do it. And how will I know? Because if I see a company increase their research and development budget, that means you're getting ready to start paying for people and you're getting ready to start paying for IP. So I'm going to the US department that controls trademarks and copyrights, I'm looking, I'm searching for your company. I'm searching for your subsidiaries. I want to know if Apple creates a new subsidiary, you can Google it and find it. You can search Apple's website and look through their filings and find it. Okay, cool. I'm typing that company in because why did you create a whole new LLC under Apple? You didn't need one. You already have 58 of them. What you create a new one for? So I'm searching for that company because I want to know what kind of trademarks did you just file? What kind of copyrights did you just file under that company? Because that's going to tell you where we're going. Anyway, I'm done.
Cool beans, cool beans, cool beans. Well, ladies and gentlemen, that will wrap up the midweek fundamental and technical analysis. As always, if these reviews, if these sessions are adding any value to your lives, to your trading journey, whatsoever, feel free to like, share, and most of all, subscribe. It really helps out a lot. If you're interested in joining the private Telegram group, visit Precision Pips LLC com and register for the silver package. With that being said, I appreciate you guys tuning in tonight, coming out, getting this knowledge and empowering yourselves. Let your family and friends know you love them while they're still here, please. And as always, peace and love, everybody. You know